How can you invest and make money in today's real estate market? Welcome to the Successful Investor Show, where we talk with successful real estate investors, business owners, and busy professionals on their journey to wealth. They share their best ways and advice to make massive gains in today's market. Make sure you are subscribed so you never miss an episode. Now, here is your host, Doron Nissim.
Welcome everyone to the Successful Investor Show, where we talk about how to passively invest and create passive income and generational wealth. I'm your host, Doron Nissim, and today I have the pleasure to welcome our guest, Ethan Diaz. Ethan, how you doing, brother?
Doing excellent. Thank you so much for having me on here tonight.
Yeah, thank you so much for coming. Ethan has been acquisition manager with DB Investments. He started at the age of 16, and right now is controlling 232 units, multifamily properties, and has self-storage, 52 units, and also other commercial properties. Ethan, tell us how you started this. Wow.
Yep. So I started at a young age. I was 16 years old. I was a junior in high school, and my father was a physician, right? So, I didn't really want to go the same path he went. It's a good income, right? But it's also you're trading your time for your money, right? And I told my dad I didn't want to go the same path. I did good in school. That was my plan, was always to take over his practice, since the day I was born. But he started taking me to different seminars, Rich Dad, Poor Dad, multifamily. Eventually, I knew multifamily is the way I wanted to go. 16, we started our business, DB Invest, my father and myself. And then after that, we bought an 8-unit. And then we started syndicating deals. Once I figured out that I know what I'm doing and I trust myself with other people's money, then that's when we started raising other people's money. Like you said, 232 units, 52 storage units. We have 6 units that are triple net, commercial properties as well. So we're trying to stick to the multifamily, but that's kind of how I got started. It's been almost 4 years. 4 years.
Wow. Wow. So you started when you were 16, and it's been 4 years. So right now you're 22 years old, or 20? 20 years old. Wow.
Yeah.
That's awesome, man. You're the youngest person that I know that doing multifamily commercial and doing syndication. So does that have any influence on what you do when you talk to people? What is your current role within the company?
So I'm kind of doing everything. My father, he doesn't have as much time as I have. He's seeing patients from 8 to 5 in his practice, and then he might be in the hospital before 8 a.m. To get to the office at 8 a.m. and maybe even patients after 5 p.m., right? And working on the weekends. So what he provides is he provides the capital raising, right? Where he has the pre-existing relationships where we can do 506B. Everyone's accredited as well. So we can do 506B or C. It doesn't really matter for us because they're physicians that my father's known for 15 years. Some of them have known me since I was, 5 years old. So for me, it's just finding deals, asset management, closing the deals. My dad's too busy to talk to lenders and, get different quotes for loans. So I'm the one doing all the loan documents, having my dad sign everything, doing all the asset management calls. So kind of a little bit of everything. And I'm the main one who pitches the deals as well. My dad will bring the physician to our office and to our conference room, and that's where my job is to pitch them on the deal.
Wow, that's a great partnership you have there. Your dad is the one with the 15 years of building relationships and knowing people, and now you bring to the table your time. Basically, it's your time that looking for deals, talking to people, and creating the relationships that you need to find the properties.
Definitely, and I tell people my dad already did the hardest part of building these relationships for 15 years, right? Before you can even pitch somebody, you have to make sure they trust you, right?
Right.
So we don't pitch people unless we know they trust us, right? So we won't even bring up real estate. If they ask us about it, we'll talk about it. But my dad did the hardest part. For me, it's the easy part of just pitching the deal and finding a good deal that works for them.
That's awesome. That's amazing. It's a great partnership, and it's your dad, so it's probably very he's like a role model for you.
Correct. He's my biggest role model, mentor, right? So, I tell people he's my dad, my best friend, my mentor, and my business partner, right? So wow. I got it all in one.
Wow, that's awesome. I love it. So, when you said you started it 4 years ago, you started to go to seminars, Rich Dad, Poor Dad, things like that. And so when was the part that you figured out, I want to do this. I'm not going to be a doctor. I want to do real estate. What happened?
My dad told me a quote that his father told him. My father's from Peru, and my grandfather lived in Peru his whole life. And he used to tell my dad, we make the same amount of money, but you have to go to work and I don't, because my grandpa owned real estate. So, and my dad was like, damn, like that's true. Like we make the same exact amount of money, but I have to clock in and clock out every day. My grandpa he had an office. He would go there. He would read the newspaper every day and just go home, didn't have to work. But, and I remember when I was young, I had a conversation with my dad about this new device he bought for his office. It's a pulmonary function test. It's just like a breathing test. And he was telling me this machine makes as much money as I make being at the practice. So when we go on vacation to Aruba or whatever, for that whole week, I'm making as much money as I would make physically there with this one machine. And he's like, that's passive income. I couldn't have been older than like 14 years old when he told me that. I was probably 12 when he told me that. And that always stuck in my head, the passive income. So I would say, like, to me, that was more of my aha moment when it came to, like, I'm not sure being a physician is what I want to do, right? I tell people I want to grind hard in my 20s and my 30s and be able to relax in my 40s and my 50s. I don't want to do it the other way around where I'm playing around, partying,
Right.
I'm not in college. So like, everyone I see in college is partying. They're not really educating themselves. So it's like, that doesn't really it's not very attractive to me, that lifestyle right now. It's something I'd rather do when I'm like older. I can relax, enjoy the fruits of my labor with my family. Right. But for multifamily, I went to a multifamily specific seminar and they explain NOI. They explain how force appreciation, how with a single family house, you can only really force appreciate it so much. Because you can, you can maybe flip it, add value, new roof, this, that, right, paint it. But with multifamily, it's more of a business instead of like a physical piece of real estate, right? It's like I'm looking at the P&L. How can I increase the P&L, increase the income, lower the expenses, do whatever I need to do to increase the value? So that was more of like the aha moment where I felt like I had more control and there was less risk.
Yeah. Yeah, I mean, definitely multifamily commercial has much more options, much more ways to increase the value than a single family is just one house. So, I mean, it makes much more sense to do on a bigger scale, but also it's much more scarier than just one house.
Yeah.
So, I mean,
the big thing for me was like the economies of scale. But again, like I said, there's so much risk, a lot of stress comes with it. I'll have friends come up to me and be like, Ethan, you must be stressed. And I tell them it's more stressful being in college and not knowing what I want to do in life.
Right.
I mean, I'm lucky that I have my father, and at 16 years old, I was able to say, this is what I want to do with my life. People are 30 years old, still not sure, right? So
That's awesome. I mean, you're actually doing the opposite way. You're working and you're building your career, and then you want to relax. People are just, but I love the goal and I love the plan, and it seems like it's working great. So is there like a deal that you wish you didn't do, or was a bad deal, or maybe a deal that you checked and you said, wow, that's good that we didn't buy it?
Yeah, so I wouldn't say so. I don't regret anything. I feel like everything that's happened has led me to where I'm at today, being on the call with you.
Right.
So our 8 unit that we first bought was a LoopNet deal. The joke is like LoopNet is where deals go to die, right? So this was not a good deal. It's just my dad. We looked at it. We're like, oh, it's like 20,000 a door. It was like, so it was a very cheap deal. We bought it, and it's like you don't know what you don't know, right? So you can read all these books, but it won't prepare you for actual real life and taking on a property like that. So we bought that property with my dad's capital. And I like to joke around and say, I'm happy I lost my dad's money, not investor money, right? And we didn't lose anyone's money, but it's just like a joke I say, because it's like, once you lose someone's money, it's hard to gain that trust back, right? It's my father. I had the good intentions, but luckily for us, we stabilized that property after a while. And it appreciated well because we bought it in like early 2019. So basically anything before COVID just, skyrocketed. So luckily we got out of that one. But I told my dad, we almost walked away from that deal on the closing table because we thought it came with extra land that it didn't come with. And my dad pulled that last second decision if we're going to pull the deal or not. And he said, let's continue with this deal. And I told him that was a great decision, because if we didn't pull that trigger on that deal, maybe we would have been too complacent on every other deal afterwards, right? Maybe we wouldn't have closed our first deal. Maybe we would have waited 2 years before we closed our first deal, So I'm very happy that happened. Obviously, like once we sold it, it was a nice chunk of change, which helped us put into the next syndication. So I don't really regret it. There's some deals I look at, like when I was like very new to the game, some deals I passed on. I'll call the broker, oh, the underwriting doesn't make sense, and they're like, how does it not make sense? And then that same deals got sold 3 times over, for like maybe it was 4 million then, now it's being sold for 8 million today. So like I look at some of those deals because I save all my underwriting from my first underwriting to the one I did yesterday, right? So
Nice.
I kind of kick myself over the ones I didn't take more than anything.
Yeah. I mean, you don't know what you don't know, but I mean,
Yeah.
I like the fact that you actually went out and closed that deal, because sometimes you need something to push you out of your comfort zone, and probably not closing it would be your comfort zone. So sometimes when you push yourself out, and because you bought that, then you knew what you don't want to buy, and you found something better and better and better. You just, went out to find better deals. So that's great. In today's market, I mean, the market is shifting. There are much higher interest rates and things like that. Is there something that you do specifically because the market is shifting to mitigate risks?
hmm So I've tried just to hone in on markets where I have assets already. Where I have so we're in Georgia, Florida, and Texas. We are mainly in Florida and Texas, right? So I've not been looking at Georgia too much. I just want to stick to where we have stuff nearby, because let's say, like you said, interest rates high. At least we have the economies of scale, right? If we're ordering, supplies or whatever, appliances, at least we can order
Right.
it in bulk, where there's some economies of scale there where we can save some money. Um,
Yeah.
I'm not really too afraid of what this market is. I feel like I don't know anything personally because 2008, I was 4 years old, so I don't really remember that crash. Or I was 6 years old, so I don't really remember that crash. But so I talked to people with more experience than me, and people told me like 5% interest rate, 6%, that's nothing. I bought my house at 14%, 13%,
Right.
whatever, right? Like I bought a house almost 2 years ago with like 2.25% interest rate. So
Yeah.
anything above 2.25 in my head is like crazy, right? Um, so I feel like deals can still work. It's more about like lowering people's expectations of what they could have gotten, a year ago, 2 years ago.
Yeah.
Debt was so cheap that people could sell anything for whatever price, and you could pay that price, right? So just I constantly educating my investors, right? Like some sellers still have that mentality of COVID where debt is cheap, that they have these really high purchase prices or sell asking prices, but they're not going to meet it. So there's no reason to be too aggressive. Eventually there'll be a correction where those prices will drop. We're currently in a refi and we got quoted 5.27% interest rate. I feel like that's not a bad rate.
Right.
Obviously it's not 3%, it's not a sub 3, but like
It's
I'm not worried.
it's so
But
good
yeah,
if it works for the numbers. Or you mean the cash? If the cap rate or the cash on cash are higher than that percentage, then it can make sense.
mhm.
That's how you can mitigate risk. You know that your cash flow, the property is cash flowing, and you refining, and you still have enough money flowing every month, so you're in a good position.
Definitely.
Um,
And something I would like to add on to that is like
yeah,
not being as aggressive with my refinance models. Because when you're underwriting and you add a refinance and you put interest rate of 3.5, 4,
right.
5, right? You're basically gambling, right?
Yeah.
You're gambling with a lot of people's money. Our first deal, we bought it, the rate was like 3%, and I did the
Wow.
underwriting at 5.25 for the interest rate. No idea, just put 5.25 to be aggressive. In my head, like, oh, this is conservative. I'm raising it 2 points.
Right.
And now we're refinancing it. It's at 5.27, and that's luck more than anything, right? So now I'm just like being more aware of what I'm underwriting and how I'm underwriting the refinance.
Yeah.
So I underwrite, just try not to underwrite a refinance into it. If you are, be very aggressive, like a 7-6%, interest rate.
Yeah, yeah. And I was talking to somebody that what they're doing is they're doing different models, which are the interest rate is going to be 2% higher or 4% higher or even 6% higher. And then they do the risk versus the return, and they make sure that it works in all scenarios. So
hmm
yeah, yeah, I like that. So we're going to move to the final round of 4 success questions and
Okay.
help our viewers to be more success in real estate. So the first one is, do you have any success habits? What are your 3 success habits?
First one, waking up at early in the morning before 4:30. That gives you
Wow.
so much time. I don't have kids, but my dad tells me how annoying it can be, and that we can bother him a lot. So he tells me,
It's
Ethan, I wake up
definitely a lot of work.
So he tells me, Ethan, I wake up at 4 o'clock and I have no distractions until 7 o'clock. That's when the first person will call me at 7 o'clock, right? And reading constantly, try to read at least 10 pages a day. During COVID, that was like the last year I lived with my father. When I was 17, I read 52 books that year, and my dad
Wow.
read 98. So
Wow.
I believe my dad
You guys
works,
compete.
yeah, I believe my dad works like 60 to 80 hours a week, every week. So if he can do it and like double what I did, then I think anything's possible. And then I think like working out, I think why work so hard if you're not gonna care about your health, right?
Right.
So like that's what I learned from my partners. Like when I first started syndication, I got out of shape. I was pretty fat. I lost I think almost 80 pounds,
Wow.
and one of my partners told me, he's like, Ethan, like there's no point of anything you do without health. Health is the main thing, so
Definitely.
if you're there health wise, mentally and spiritually, that's kind of all you need, right?
Right. Yeah. Those are great three success habits. I mean, waking up early so you have enough time to do what you need to do. Reading books, 10 pages a day. So I love it. I do it also. And working out, taking care of your body. Those are great habits. Is there a success resource that you use, like a good resource that you use on your business?
So a good resource I use for my business is the Department of Numbers. I love using that for market research. And then I think for me the best market research tool is probably the government, census.gov, right? So census.gov has kind of revamped their website in the last 3 years, I believe. So it's a little different than it was before. It was a lot easier to get like everything you needed. Now it's kind of like a cleaner look, but still a lot of information on the census. And then Department of Numbers, I think it's like DEPT of
Wow.
numbers.com.
I've never heard of Department of Numbers. I know census. So what do you do with those websites? How do you use them for your business?
So I'll shout out Joe Fairless's book, The Best Ever Syndication Book. He speaks about how to do market research, and he literally tells you exactly how to go on census.gov and how to extract every piece of information that you need, and how he does his market research. And I love the way that he did it. And I studied that book almost like a textbook, and I created my own Excel spreadsheet. And
Nice.
with all the different metrics that he takes into consideration, like population, supply and demand. Supply and demand is vacancy, and then rent growth. So seeing what the vacancy is, what the rent growth is,
Right.
population growth, job growth, and then each thing is ranked in a different tier. So for example, supply and demand matters a lot more than population age, right? So just kind of ranking those on a tier system and then seeing which one ranks as a higher market. So when I first started a few years ago, 4 years ago, I did that, and then I looked at it. Okay, Tampa looked like the best market, so I just like only started calling people in Tampa, right? Kind of like try to hone in on Tampa.
Right.
Um, what I learned later was it's better to not do one market. You can't put all your eggs in one basket, or you might not get
Right.
any results, right? So have at least three markets, three major markets that you know very well, that you have like,
Yeah.
your finger on the pulse, right?
Right.
But so that's what I do with Department of Numbers. I can see what the rent on average is and the vacancy on average for the past, like it doesn't show you this year or the last year, it shows it the 3 years ago. So I'll get that information, and then even for vacancy, I'll start cold calling a bunch of apartments in the area, and I'll ask them what their occupancy or vacancy is. I'll even pretend to be CoStar, just getting like a report, and doing
I
market
love
research.
that. Yeah, it's a great strategy to call them and say, "Hey, I'm either a co-star, LoopNet, I'm a leasing agent. I
Yeah,
just want to know how many vacant units. I have a lot of renters looking."
and you'd be surprised how fast people are like, oh, it's 87, 85. Just say,
Wow.
hey, I'm doing market research. What's the vacancy? This, like, they're so quick to give it to you.
Yeah, yeah, it's a great tip. Actually, for somebody who's looking to invest in an area and doesn't know what's the vacancy, call the local complexes, apartment complexes, and ask. Very easy and simple. All right. So the next question is, what are your three tips for making money in real estate?
3 tips for making money. For me, my main tip is not trying to make money for myself, is make money for my investors, right? Um, I feel like a lot of people are very greedy when they come into deals. Some people, I'll talk to this about with other investors. It's some people are like retired, meaning that they need to syndicate to make money to put
Right.
food on their table, which is not really retired. They're working now for the investors, right? So
Yeah.
my father being a physician gives us a stronger financial backing. So we don't need to do deals. We do deals that we like, not deals that we need, So that's like, I would say
That's
one
awesome.
difference.
Right.
Um, Three. I'm trying to think of three. That was just one I can think of. Um, I would say in the beginning, look for higher risk investments. The triple net deals are nice, and it's kind of the way I want to lean towards. We have 6 triple net deals or units spread between 2 complexes, and I love that because it's like a lot less
Yeah.
underwriting to do. I can underwrite it in my head.
Can you explain what is a triple net deal is?
Yep. So you might see deals where it have three N's and an N. So that's a triple net deal. That means that you're just netting straight income. They pay for the taxes, the insurance, and then the repairs and maintenance on the property, right? So, for
So
example,
basically, the tenant pays all the expenses and give you
just
the
straight
money.
income.
I mean, yeah.
So an example might be a Dollar General. Every business has a different, like business plan. Dollar
Right.
General is not really about buying real estate. It's about like doing a 30-year lease, somewhere like McDonald's is like they buy the real estate, McDonald's owns it. But
Right.
so properties like that's kind of like the route I want to go to. Or like double net. Double net is like they don't pay for the repairs and maintenance, so it's a
Right.
lot less risk, but it's a lot less reward as well, right? So in the beginning you have to take risk, but you don't have to take there's risk mitigation as well, right? Like that's why we
Right.
choose multifamily, because there's
Yeah.
not as much risk as there is in single family.
Right, and you diverse it. Sometimes you do the triple net, which is less, less risk, and then you can do the value adds B to C property. There's little bit more risk and things like
And then
that.
I guess the third tip would be, if you're like a passive investor, is diversify, right? Not only diversify in the investments that you're doing, but diversify in the syndicators that you're with, right? My father, he invests in syndications, probably 4 or 5 different syndicators, right? And what I love about him being so, spread out between different syndicators is that at different times of the month he gets his checks, right? Or different times of the quarter. Some are
Right.
monthly, some are quarterly, and it's just nice getting that cash flow coming in, right?
Nice.
And there's one that's like not cash flowing at all, and he bought it like a year, or invested over a year ago, right? And there's one that's doing 10% a year that he invested like a few months afterwards. So it's like he doesn't even care, because he's getting 10% in a deal where like the market is not 10% anymore. You're saying 6% on deals, right? So
That's
him being
awesome.
diversified doesn't really make him stressed out about that one bad deal.
Right. That's a great tip, actually. Investing in few different syndications, few different projects, and they can, if it's quarterly, they can pay you each quarter, but it's different quarters, so you can get it every month, and it's a good way to make money passively. So it leads me to the next question, which is the last questions. If people they want to invest in real estate, they love real estate, they hear about real estate, everybody's invested, but they have full-time job, no time. What can they do?
One good resource I recommend is by Brian Burke. It's the Hands-Off Investor, right? And it's, there's so many benefits with passive investing in syndications, right? I'm extremely bullish on multifamily. It's what I've been doing for the last 4 years, right? And I've looked at all the different, aspects of commercial real estate. Multifamily makes the most sense. There's nothing like that's like risk proof, or
Right.
there's nothing is recession proof, but multifamily to me is recession resistant. So if I can just mitigate my risk as much as possible, then why not invest in multifamily, right?
Right.
The economies of scale, right? The forced appreciation. The main thing to me is the depreciation. There's depreciation in a bunch of other assets. Like the main depreciable asset is gas stations, but they're not cash flowing the same way, right?
Right.
And so I know mobile home parks, that seems like something that I've like, if I did stray away from multifamily, it'd be mobile home parks. But I think just going on LinkedIn, finding a syndicator, an investor that you connect with, right? For me, when I'm being sold on something, I don't want to feel like I'm being sold. I want to feel like I'm having a conversation, and that I like the person so much that I want to buy into it because I like them that much, right? So
Right.
find somebody who's not really trying to sell you. Find somebody that you connect with. It just happens to be like all of our investors look like my dad, talk like my dad, are the same age as my dad. They're all foreign doctors in their like early 50s, right? Like late 40s. So find somebody that you connect with. Don't jump into it. You never want somebody to be needy for your money, right? And you can pass on 2 deals, right? And then invest in the third one. But if you see they're too eager, they're too needy, they need that money,
Right.
maybe they're not the right fit for you. So just be patient, find somebody you connect with, and do your research. So like the Hands-Off Investor is literally for passive investors to read on how to vet a syndicator and what they should know
Which
about
is good.
syndication.
That's a great tip, because I don't hear that often. How can you vet the person that you're investing with? So that's a really good tip to check who you're investing. Yeah.
And I think it's important to know what you're investing in as well, right? Because some people have invested in my father and us, and they'll cut us off. Like, doctor, I'm investing because I trust you. I don't care about these random numbers. I don't know what they mean, right?
Right.
But So, but like they should look into it, right? And we try to educate them, and we appreciate people like that, but we would prefer they know what they're getting themselves into, right? So that book helps, like cap rate, preferred returns. What is a preferred return, right? What split are you getting yourself into? What are the hurdles? You'll see some deals where it's like after we give back our 7% preferred return, the split goes from 70-30 to 60-40, and it's like they're just stealing equity, right? It's just like because they're just putting so many things into the legal paperwork that you can't understand what you're reading, right? So just know what you're getting yourself into, know who you're investing in, and educate yourself.
Yeah, I love the advice. I mean, educate yourself first. You want to invest in real estate, you don't have time, but you need to take the time to educate yourself and know exactly how the business works, basically, how this whole model works. And then get in touch with people and connect and see who you connect with. And then start learning on their business and on their investments and invest with them if you feel comfortable. Yeah, I love that. Yeah, this was great. And do you have anything else you want to tell us? Or how can they connect with you? How can people connect with you and get in touch with you?
One more important thing is like teaming up with people, teamwork. I wouldn't have felt confident in doing my first syndication if it wasn't for my partners, Power Capital Group, Thomas and Brent. They were also in the same mentorship group that I was in, that we're both in. So teaming up with somebody that really gave me the confidence to do the syndication, and also gave our investors confidence as well, because like, oh, these people, they have thousands of units, they've syndicated multiple deals, right?
Right.
And to connect with me, our website is dbinvest.com. My Instagram is Ethan T Diaz, and then my email is ethan@dbinvest.com. And feel free to reach me. I can send you my Calendly link. My Calendly link should also be on my website as well. Always looking to connect with new people.
That's awesome. That's great. Thank you so much, Ethan. This was very insightful. And I mean, seeing you only 20 years old and doing this incredible things is very inspiring. Yeah, loved it. And we'll be in touch. Thank you so much.
Thank you so much for listening to this episode of the Successful Investor Show. If you're enjoying this podcast, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Once again, thank you for tuning in, and we hope you'll join us on the next episode of the Successful Investor Show.